want to welcome you to our second webinar titled Modern Portfolio Opportunities. And we're going to discuss 10 opportunities that make sense in 2025 and at high interest rates. So we'll get kicked off here in about 30 seconds as people get in and everything gets loaded up. But while we do, can anyone out there just let me know you hear me and see me and say yes, or let me know what part of town or the state or the country you're in. So if you do, say good morning. All right. I see him coming in. Thank you, thank you, thank you. No surprise, lots of Denver people. Awesome. All right. Well, we will officially get this kicked off here because we have a lot to cover. We have 90 minutes. I think we'll use every minute on here, going into a lot of details. So this is our second webinar on 10 modern portfolio opportunities. This is part of our annual portfolio analysis mastermind, and we're really focused on the new rules or the new opportunities for building wealth as a front range real estate investor. Now, 2 weeks ago, we did webinar 1, and we had our follow-up masterminds on there, and those are really focused on 2 things: understanding how your portfolio is currently performing and clarifying your goals. So we're going to drop a poll here in the webinar, and I'd be curious. It's a high-level snapshot of just what your overall ROE performance is on your portfolio. Take a second, fill it out, please. It's always fun to have the data on here. Now, what we're focusing on this webinar, which is week 3, the 10 opportunities, and then week 4, we have our in-person masterminds and virtual masterminds to come talk about, hey, what opportunities might you invest in to rebalance and optimize your portfolio? So quick disclaimer here, we will be talking about 10 deals. A lot of these are live deals or live opportunities. So we are going to use a lot of forward-looking statements. We're going to be using a lot of data that we have sourced with our investments, our data, a lot of our partners. Always go out there and verify the data. And understand all investing always does involve high risk. And this webinar is not offering any investment opportunities. That would come in the form of PPMs or contracts as you dive deeper into the opportunities on here. So coming in here for the polls, we are split pretty evenly here. So just under a third are red light below 10%. Just about under a third is yellow light, 10 to 15%. Ooh, just under 20% is green light, and 27% says not sure, not calculated. Well, if you're in that not sure, not calculated, go to propertyllama.com and make sure you upload your portfolio. So thank you for filling that out. This is no surprise. I was expecting majority red and yellow lights. All right, so the agenda today, I'll do a quick introduction for myself here in a minute. Then we're going to talk about the 4 phases of the real estate market cycle and where we are currently sitting. Then we're going to go through 10 opportunities for 2025. And then we'll go through and end with getting you plugged in the next mastermind, with the action goal being to take thoughtful action on your portfolio, because anytime you transact in real estate, it involves risk, and there are transaction costs in real estate. All right, so getting on with the webinar. My name is Chris Lopez here. For those who don't know me, I'm a Denver real estate investor and entrepreneur. I invest here in Denver. I've built a couple businesses over years on connecting people to direct loan opportunities, and also a lot of passive opportunities and syndications as well. I'm one of the co-founders of Property Llama and also the author of the annual guide. And our 2025 book will be coming out in February this year as well. So I do a lot of my teaching and networking through the Denver Real Estate Investing podcast. This is, frankly, how I get a lot of my deal flow. I learn, and I also look for opportunities for myself as an investor, and a lot of times aggregate them with our investor base as a whole. And I teach all these wealth building concepts on Bigger Pockets at their conferences and on their YouTube channel. And now I get the privilege of doing a lot more with their Passive Pockets, reviewing live passive deals and really talking about the importance of due diligence on operators on there. So let's jump into the 4 ways of the market cycle here. And this is where I just want to take 2 minutes before we get into 10 opportunities. This is a graph I think everyone has seen before, or at least some iteration of it. And it states that there are 4 phases. Phase 1 is recovery. Phase 2 is expansion. Phase 3 is hyper supply. and phase 4 is recession. Now, there are opportunities in all these trends, but different phases of them have different opportunities and also different levels of ease. Now, for a lot of what we saw from 2010 to 2022 in residential real estate, we've just had this huge recovery and huge expansion. Is what we saw in single family and residential. Now, commercial is a different story, and this where it comes down to is like the asset class and the geographic market have two big factors at play in here. So with residential, we saw a big expansion here in through phase 2, and we're not really hitting hyper supply since we have just a lack of supply. So we're having a very mild recession, very, very, very mild recession with it's kind of flat and some negative price appreciation on there. But you flip over to the commercial market and really like apartment buildings is what I specialize in. We saw a lot of expansion, and now we have gone through a hyper supply. We've all seen the cranes downtown, and we have been in a recession for a while. So I'd be curious out there in terms of like multifamily. We're going to do another poll here. Where do you guys think we sit in terms of the 4 phases of the real estate market cycle? So answer that, and we'll come back and do some poll dissecting in a minute. And the reason I want to bring this up is because, I really got serious about real estate. I bought my first rental in 2011, and I got bit by the bug and made it serious around 2014, 2015, and started getting traction then. So, I missed a lot of the crash, a lot of the early recovery. I caught the last 2/3 of it. And ever since then, like a lot of investors, I've been like, hey, I'm building a lot of wealth right now, riding this growth trend. But when 2008 happens again, when that next crash happens, I'm going to be ready to take advantage of it. I'm going to have the experience in real estate as an operator. I'm going to have a way more capital go out there, a lot more confidence. I'll just have that, 10 years of wisdom, right? Still got hustle, got my wisdom, along with a couple black eyes along the way. So I've been mentally preparing for the next opportunity. And I know some of you have as well. Well, we are here, and this is the time to make sure you and your portfolio are ready for it. But here's the thing. The crash is not happening like last time. A lot of it is happening in the commercial space, multifamily and apartments specifically. So here's that same 4-phase graph, just outlaid differently of a viewership on here. Sorry, I was dropping the poll in the chat. Can't multitask. So we have gone through this hyper supply phase. And I think right now for multifamily in Colorado, a lot of the markets, we're at the tail end of this recession here. And so, yeah, we're in a very mild recession for single family, but we're not seeing huge opportunity or huge price drops. We're in multifamily, we're seeing anywhere, from a 10 to 30% price drop, depending on the asset and part of town we're in. And it's been like that for a while. So we are coming back out of this recession. I think in 2025, we'll get in the early stages of recovery, kind of by the end of 2025 is my prediction. So this is that next giant recovery wave. So the last couple of years, this is what I've been focused on. I've been transitioning on my assets over to catch this recession and this recovery, because you see a lot of the deals we do today in 2025, and we sell them or refi them in phase 1 or phase 2. We are going to dispose them into the seller's market, meaning we have tailwinds. Hey, we are selling, and we should hopefully get, top dollar or a lot more than what we paid for it. So a lot of people are basically saying we're split between hyper supply and recession. So phase 3 and phase 4. All right. So, yeah, so I agree. Hyper supply recession. I think we're out of the hyper supply, but again, that's where I'm at. But overall, I think everyone agrees we're not in recovery or expansion yet. All right. Thanks, guys, for participating. This makes it way more fun for me. All right. So with this said here, hey, I'm an investor myself. The team members here, they're investors themselves. And, what we have said, and many of the property law and the software users have said, hey, look, guys, I understand my property is in the red light. You're pointing how it's underperforming. You're pointing how the cash flow sucks. Great. Give me some solutions as well. Don't just point out the problem. Give me some solutions as well. Well, this takes us into what we've really focused on this last year in developing what we call the Property Llama Marketplace. And these are the different opportunities, in this case, 10 different opportunities all across the spectrum, some local, some out of state, that depending on your risk tolerance, where you are in your investor journey, financial situation, all that, different ones will make sense. Our goal is to deliver a bunch of opportunities, and then you pick the one or two or three that make the most sense from the buffet for you. So excited to launch this and get kicked into the 10 deals. Quick disclosure, we make money by doing deals on here. Some of the deals we do ourselves, some of the deals we partner with people and have various referral agreements with. So I want to make sure everyone knows, hey, if you do a deal through this, there's a good chance we will make some money, but that's our intent. We don't want to go out there and sell masterminds and gurus and all this stuff. We rather go out there and tell people how to do deals and then help people do deals. All right, so jumping in here to all the data, we have three main options in any rental: keep it, refinance it, or sell it and reinvest. So we will go through the 10 opportunities in this format. We have 2 for keep it, 2 for refinance, and 3 for sell and reinvest. So getting into the keep opportunities. One thing happening right now in Denver and Springs and many markets is that long-term rentals in a single family house, so a 3, 4, 5 bedroom, is really not the highest and best use of it in a lot of cases right now. And so right there, there are opportunities for converting an existing SFR to a different strategy for cash flow. We know buying a long-term rental single families don't make sense right now, but for those existing landlords, there's 2, I would say, prime conversion opportunities in the current market cycle where you can convert it from a long-term rental to one of these 2 strategies potentially. So opportunity number 1 is co-living or room by room conversion. Now, this is a really creative solution for the affordability crisis out there, meaning we all know we don't have enough houses and affordable rental units for people to live in. And a lot of factors really affect Colorado and many other places, almost impossible to build affordable housing. Like, for example, builders focus on higher priced properties. There is a gentleman at one of our masterminds last week. He used to do a lot of flipping, and now he and 3 partners, I believe, last couple of years, they moved into development homes. And he's like, hey, everything I looked at, we're basically building $2.5 to $3.5 million spec homes. I got another partner on my team, Paul. He's doing a really big project. It'll be around that $2.5, $2.8 million that he and his wife, Valerie, are working on for one of their rentals to add a mother-in-law suite and add ADU. And so what he knows there, these are multiple 7-figure priced houses. Why? Because that's where it makes sense for a developer to take risk, unless they can do mass construction for affordable housing, but usually higher end, and 9 out of 10 times is going to be the most profitable. So that's a big reason why we have an affordability challenge here in Colorado. So co-living is a simple and affordable solution. So let's go through an example here of taking a 4-bed, 3-bath house and convert it to a 8-bed 4-bath house. Got my slides here. All right. And so one of the things historically that's been an issue for the room by room, because we've been doing this for about 5-6 years, I say we, a lot of my investors, house hackers and hands-on operators have self-managed room by room rentals with a lot of success, often achieving 10 plus cash on cash return numbers. While it's the best for cash flow, it's harder for busy investors to implement. People like me where, hey, you got a busy career, you got a family, and you have more financial equity than sweat and time equity you can put in the properties. So a really cool thing is that this company called PadSplit, they entered the Denver market in late Q4 2024, and they're the nation's largest co-living marketplace. And so they have a streamlined opportunity to help landlords convert their properties and then also get tenants in there and make it a lot more hands-off than you could traditionally do. So here's an example I talked about earlier. We're taking, and this is a real deal that someone bought last year in Westminster. It's a 5-bedroom, 3-bath house with the intent to convert it actually to an 8-bed, 3-bath house. So I took what someone bought and then I mirrored that over a similar property where landlords own this for many, many years. So I'm kind of merging 2 examples here. So you can see we're at a 30% LTV, 3.5 cap rate, and a red light ROE. So red light, we got to change that. So the left side here is the long-term SFR as is. This middle one here is the conversion after it's stabilized and you're self-managing it. And the third one is conversion, but having pad split manage it. So look at this. If you convert it, this landlord could be moving up into like the green light ROE into the high teens. Now, the biggest thing that changes is cash flow. You can see cash flow can absolutely 3 or 4x on here. Now, if you look at the pad split, so this would be really good for someone that's going to be hands-on and willing to spend a few hours a week minimum to manage it, kind of like the equivalent to streamlining your Airbnb operations. Now, if you have a property you want to hold on to, but don't have time to manage it yourself, pad split is the best marketplace and best co-living partner I have seen out there in the marketplace. So while you make less cash flow, about 43,000 rather than 57,000, you can see your ROE is 14.5%. So ROE is almost in the green, and your cash flow and equity is in the 9% range. And so this is something where if you're acquiring, a lot of house hacking, self-managing makes sense. If you have a current property, I would definitely look at conversion with a potential pad split type, manager on there. So all those numbers are exactly the same for the two scenarios, other than pad split has fees typically range in 16 to 18% after PM fees and a few other things. So in that example, I had it at 17.5%. So the key points here is that these are the strongest cash flow opportunities. Really, the only way we're seeing a lot of times double-digit cash flow in Denver and Springs. They work best when you can convert a single-family house into the 7 or 8 bedroom range. And yes, there is demand for it. As I said, numbers are hard to work for acquisition unless you're like a house hacker self-managing, but an amazing opportunity for landlords that want to self-manage out there. So a couple comments on here. I didn't put the cost on here. I obviously left out a lot of details to be high level. Cost to convert, a lot of times, if you're doing it yourself, a lot of times it's anywhere from 10 to 15,000. If you're doing more hands off, I'd say in the $15,000 to $30,000 range, with a lot falling in that $10,000 to $20,000 range for conversion and some basic common area furnishing. So I didn't put that in the model up there. Again, I'm giving very high level numbers on here to help people understand the opportunities. But it's usually about 5 to 10 grand per bedroom. And of course, you can save a few bucks as well. All right. So great question. Keep them coming. But we are going to go fast and furious today. Opportunity number 2, medium-term rental conversion, or MTR. So what is a medium-term rental? This is a furnished rental where you rent it out for more than 30 days and typically less than 6 months. I don't think there's like a hard rule that has to be 6 months or less, but there is kind of a hard rule that 30 days or less. Generally, that once you get 30 days or less, as Airbnb or short-term rental, and that's usually where municipalities that have rules, that's where they say, hey, things are 30 days or less. They have the bans or Airbnb regulations. So who's staying in these properties? Traveling nurses, digital nomads, people who are relocating for jobs, consultants on, multi-month projects. Divorcees are very common as well. People coming to support family in hospitals. Think around Craig for, neuro and brain stuff. Visiting grandparents or visiting family. A lot of times rent these out. Now, the two opportunities we see here are conversions at like 1 or 2 bedroom levels. And then also conversions for like 5+ bedroom houses in kind of like some premium locations and newer houses. So those are kind of where we're seeing the best opportunities in medium-term conversions. That 3-4 bedroom is usually kind of like no man's land from the little bit I've seen so far. But I see people doing small bedrooms and larger bedrooms to fit these various, hey, if you have a family, you need more than 2 bedrooms a lot of times. Opportunity alert, Key Renter Denver, which is an established long-term PM. Last in Q4, they launched a dedicated medium-term rental property management division. So they can help you with quotes. And also, we did a property walk a few weeks ago, and we're doing another one, I think, next week. So if you want to come walk a property with us, let us know in the chats, and we'll get you those details. But let's look at the numbers here. So this is actually, I love it. This is actually the owner's property at Key Renter, Brandon. He's converting a long-term rental. So your typical Cap Hill condo from a long-term rental to a medium-term rental conversion. So you can see currently as is, it's a red light equity and rents for about $1,380 in the long-term market. Now, in this comparison, I've got the left as is long-term rental, right is the cap hill conversion. So you can see return on equity bumps up slightly, hey, by 2 points here, but cash flow increases 3 to 4x. So it definitely helps with cash flow and goes from 1,500 to about 4,300. And for this property, a lot of them, $5,000, $6,000, $7,000 in conversion costs, with a lot of it being just furnishings to go in there and do it. Obviously, the bigger the properties, the more expensive. But I think this property was about $6,000 in conversion. So you can see here, great way to increase some cash flow. And especially since the condo market is soft right now, if you want to sell that property, hey, maybe do a medium-term rental for a couple of years and then sell it in 2 years when condo conditions have improved. All right, so the key points here for medium-term rentals. Location is really, really important. And co-living and room-by-room, location's not as important. There's demand all over the place. Lots of demand in the suburbs for room-by-room rental. Medium-term rental, look more like Airbnb. Location's a lot more important. Where is that family staying? A lot of divorcees go to Greenwood Village and DTC area. Are you near a hospital or a trendy spot? So typically, after the higher rents and higher expenses, including a PM fee, we were typically seeing about a 15 to 30% after expense cash flow increase. Now, if you self-manage, obviously it will be higher than that. So like I said, best opportunities are for conversions, really hard to make work on acquisitions. And I see lots of great questions in the chat and that the property development team is answering. So thank you. Keep those questions coming and either me or the team will answer them. All right, so that wraps up our 2 opportunities right now that I see for conversions. It really makes sense to keep it, but also juice to cash flow and potentially get ROE, up quite a bit. So if you currently have a rental or you want to keep as an LTR, make sure you are in compliance. A lot has changed the last 2 years with Colorado legislation. While we are experts at financial performance optimization, we are not experts at asset management and compliance. That is, again, where Key Renter Property Management has expertise, and they are offering landlords from PAM a operations and compliance audit, and they'll take you through 6 steps of rental market analysis, review your lease, check if you need a rental license, review utilities, review your property listing, and they give you a nice portfolio audit for maybe some areas that you're not compliant in and some opportunities to increase revenue and therefore increase your NOI and cash flow. So I see commenting here for medium-term rentals. Yes, they are furnished. And some that's amazing at revenue operations for short-term rentals. He says, hey, it's super important to understand how seasoned mid-term rentals can earn double in summer compared to rental. Great comment, Jake. If you guys need some revenue operations expertise, Jake is the man to go talk to if it's a short-term thing, want to set eyes on there. Now, if you want to go out there and get this Key Renter audit, email John at keyrenterddenver.com, or make sure you come out here and fill out this form where you can choose what opportunities you're interested in on here. So I put the link on here. You can see the page. We have all opportunities on here. You can click the ones you want. And on the next page on here as well, we've got opportunities to select the compliance operations along some other information and property walks as well that's in the pipeline. So we will drop that link in the chat. So make sure you grab that and then fill it out. And we will be sharing this a lot through the webinar. Someone said, if I heard correctly, $6K for furnishing seems low. I can't really speak on the conversion on that, Kim, but I think you can definitely reach out to Key Renter. Again, I think this is a 1-bedroom cap hill condo, 500 some square feet. So I think it's going to be, very small and, it doesn't have to be ultra luxury in that neighborhood. All right. Great questions. We'll keep the train moving. So let's talk about the second part on here, which is some refinance opportunities. So we got 2 in this area. And this was another key question that one of my mentors enlightened me with years ago. He said, refinancing a property is essentially repurchasing the property. Chris, before you refinance this property, would you buy this property again today, knowing what you know today, at today's numbers? And again, that hit me really, really hard. But this is a question every landlord must ask themselves before refinancing. And I will drop another poll on here, or I should say, Jules will drop another poll on here for how many properties would you buy again at today's price? All, most, some, none, or not sure. So I'd be curious to see. All of mine are all of them. And that's why I've been disposing of a lot of properties. But this is a really good exercise to go through. And we'll visit this poll here in a few minutes once we go through opportunities. But it's a really good exercise to go through because you are essentially repurchasing. If you think about taking out hey, you're down to 20%, leverage, and then you do a 75% or 65% cash out refi, that's the equivalent of putting down 25 or 35% down on the property there. But there are definitely some instances where it makes sense. Now, I always ask, like, hey, before you refinance the property along that, would I buy it again? Hey, is this a trophy or legacy asset? Is it like an amazing asset, great location? Most properties are not. I don't mean that in any offense. Mine certainly weren't. They're, Denver metro suburbs, Class B, Class C properties, nice properties, but it's not like an amazing piece of real estate in a certain location or amazing, unique property somewhere. It's just, hey, that's kind of like your standard, mid-market type property. Yeah, great property, but not trophy or legacy. So this brings us to opportunity number 3 here, which is doing a DSCR cash out refinance. DSCR stands for debt service coverage ratio, which is a loan that's not your traditional Fannie or Freddie loan. It's a lot of people call it an investor cash flow loan. It's a non-QM loan and allows you to qualify on the property, more on the property's performance and less on your personal, DTI and bank statement. So these are great loans for self-employed people, investors who have very complex tax returns. But most importantly, they also make sense in the current marketplace. Like when conventional rates were really low, pre-2022, DSCR loans really didn't make sense on a pure interest rate basis. There's more for like, hey, you're self-employed, or how many investors or realtors out there use DSCR loans to buy properties. It was a lot of them. Hey, they couldn't qualify through a traditional mortgage, so they turned to DSCR. But what we're seeing now is that DSCR loans a lot of times are actually cheaper in terms of interest rates than your conventional cash out refi. So here's an example from a Colorado Springs fourplex that client bought a while ago and either has it in cash or very low leverage. And so looking at conventional cash out refis, he was getting quotes in the 7.5% to 8.5% with a few points. The DSCR came out, I think, somewhere right around 6.5%, give or take an eighth of a point there. And it was actually fewer upfront points. So if it's a great asset, and then, hey, we're going from 7.8 to 6.5, that's a pretty big spread there. So if you have a property that you want to hold on to, I would definitely put DSCR on your radar. And if you need a good DSCR lender, fill out that form. We have an amazing one. Same one that gave this guy this quote, and 9 out of 10 times they are kind of like beating a lot of people in the marketplace right now. So opportunity number 4, this is a second strategy going out there to extract some cash. So this would be an investment property HELOC, or home equity line of credit. Now, home equity lines of credits are great because these are mortgages in the second position. So if you have, hey, that 3 or 4% very low rate interest rate, you don't want to give up, a lot of times 30, 40, 50% LTV or less, you can put a HELOC on there, which is in second position. It's going to have your cake and eat it too. Works. Everyone under the sun can get one on their primary residence for the most part. Very easy. Lots of banks do it with some great terms. Very few banks do it on investment properties. So I know one Colorado bank here that is always consistently offering them, and some of the best. So this bank will allow investors up to 2 investment properties with an 80% combined LTV, meaning, hey, you got 40% on your 3.5% mortgage. They'll give you up to, a 40% more leverage on there. So your first position loan and your next one meets 80%. So a lot of times these are like prime plus a third of a point. So right now around 8% rate. So if you want this intro, fill out that form. I'll make an introduction. Great banker we've done a lot of deals with, but an amazing opportunity to go out there and get some, a second position on there. So I like this play a lot. If you have a great property, but you want to keep that that first position low rate mortgage in place. And there's always a couple banks doing it. This is where you want to make sure, hey, talk to people we need, but go out there, research, call around and talk to a lot of banks because different ones are offering at different times. If you have a great one, let me know. That's how often I learn about different HELOC opportunities myself. All right. So let's go take a minute here and go look back at this poll. And we got the distribution here. 3% say all of them. So how many properties would you buy again at today's price? 3% said yes. 29% said yes, most of them. 41% said some of them. 22% said none of them. And 6% said not sure. So kind of what I was expecting for distribution. Usually that some is it because, hey, there's probably some that make sense and some don't. So want to talk about one more thing here on the actually, I'll say that for later. Moving on to the sell opportunities on here. So this is where we're going to spend the bulk of today's webinar on, is going through 6 sell opportunities that make sense in today's market. Now, based on the appreciation Colorado's seen since the 2008 crash, and then the current interest rate environment, generally speaking, the best way to maximize investors' ROE is by selling. For, I'd say, 9 out of 10 properties and people I meet, that's usually the best way for landlords with property here in Colorado or other high appreciated markets. Now, as you all know, the old playbook no longer works. And we're in this new market cycle. We're at this, I call it fork in the road. That's how I mentally view it. We can go down this route or down this route. So what this means is the third route, that hands-off active investor, are very limited. And that's what I was in this last market cycle for a while. But hey, go out there, find a property. Hey, find a good to really good deal in the marketplace. Not amazing, but a good to really good deal in the marketplace. Turn the keys over to a property management, long-term rental, a few bucks to make it rent ready, and it would cash flow and it would grow. It worked extremely well in the old market cycle, but for most places in Colorado, that's no longer there. And so it used to be like 3 roads to go down. Now it's really 2 roads. Now, there are some amazing opportunities for people that want to be active, hands-on operators. But this is like 15, 20 hours plus a week. I'd say a lot of times, if not more, for being active, not the, 5 to 8, 5 to 10 hours. This is like your main thing or, one of your 2 main things you're doing for the most part. Or passive. Let your capital work hard for you rather than you owning directly the asset. The operators out there who are active, they need capital. So there's limited sweat equity upside to go out there and pull out these properties unless you're fully committed and fully serious. And we'll talk more about this throughout the example. But with that in mind, I want to really keep that in mind. We're at this fork in the road, and we're going to talk about, hey, really being active hands-on or really being passive hands-off. And generally speaking, one of those routes is going to maximize your equity and maximize your return for you. So opportunity number 5 here, this is the first one in sell, is to sell your current asset and do a 1031 exchange into new builds in up and coming markets. So I don't think this is proper English, but Denver, Springs, a lot of Colorado, and our markets, they have up and came, right? That growth wave is over. Now the opportunities I see is, hey, invest in the next up and coming market. Where's the next Denver? Where's the next Springs? Where's the next Nashville? Where's the next Salt Lake City? Where's the next Austin, right? Where are the next cities and markets that's going to go through their next growth wave? So I like that area where if you can kind of catch that growth wave, well, we all know what that did for Colorado the last 12 years. Hey, catch that growth wave and you can have that Goldilocks. Get some cash flow and have appreciation, that Goldilocks zones. Hey, appreciation and cash flow, which we don't see here in Denver for the most part. You pair that with the opportunity of buying turnkey new build rentals. So understanding this is that a lot of builders are sitting on a lot of inventory and they will sell tranches or some of that inventory to investors. Why? Well, number one, they usually have their internal fiscal dates, their end of quarter or end of fiscal year dates that they have to meet certain loans by for achieving certain, loan qualifications or unlock the next loan to the next building, build out of the subdivision. And a lot of times, too, they also sell off MLS. They can do it through word of mouth, or they have their network of investors or brokers that know the game. And so this does not go on, not on the MLS. So it supports their higher public listing values. It's one of the ways builders, they work the system. And then also, this is reality. We all know this. Consumer demand is simply down for new houses. So they got inventory. They want to sell them. And they have certain ones they need to sell. So that's where investors come into play. Now, in Denver, and actually up and down the Front Range, we would always capture anywhere from a handful to a dozen, if not more, deals a year like this. Pre-2022, we'd have a couple builders we would know, and they'd say, hey, we got to close. We got 3 properties we got to move by the end of the month. Do you get any buyers for it? We'll knock off $3,000 and put in, this, and this of $20,000 worth of concessions. Great. So that was when Denver was working well or growing well, and we got some great discounts. Problem is, turnkey rentals, even at a slight discount from builders, still don't work in the Colorado market for the most part. But there are some opportunities out there for high-end house hacks. There's a lot of people out there who are still active or hands-off, or they're kind of going through a life event, or they're buying a house. You can get a 5 to 15% discount. There's a gentleman Q4 last year. He was down in Parker, a house that was, 1.1 million and change in the subdivision. I think he got it for like low 900s with some incentives on there. He's a move in, build out the basement, and then have a mother-in-law suite to rent out and make like $1,500, $1,800 a month in cash flow. And he's going to stay in this property for a handful of years. Amazing property. Layout works great, but it's a high-end house hack where, since he's merging house hacking and some sweat equity, he got an amazing, amazing deal at, 20% plus discount. So continuing on here, hey, that's great for a handful of investors out here. Not great for a lot of people like you and me on the call. So we met this broker at Bigger Pockets conference last year who's built an amazing deal flow niche around turnkey new builds. And so he has this deal flow for new builds, but also in many up and coming markets. Now, the cool thing is they pare down these builder rate buy downs a lot of times in the 3.5% to 6% range for a 30-year Fannie or Freddie loan. A lot of times they'll throw in additional builder incentives, closing cost, some extra upgrades to the house. And a lot of times you'll get 1 or 2 years of free property management as part of the builder incentive. So I went through and just kind of picked 2 properties from a high level that kind of makes sense to model for that low ROE condo I have with about $200,000 in equity, and also in a general market that I very high level just like. So here are 2 properties in the Charlottesville, North Carolina area. So this is a single family home, and I won't read all this, but you guys can download the slides and go through this yourself. But look at this, 5.99% interest rate, getting 2% in closing fees, and then a slight discount too on the purchase price compared to the initial market value. End of the day, these properties will be cash flowing $300-$400 a month, and I can get in here for $72,000 in down payment. Property number 2, again, I'm about to model at a 1031 exchange here. So going from Denver to North Carolina. This is a duplex property, different town, but greater Charlottesville area. And see, it's about a $500,000 purchase price with a slight discount from initial market value, but it should cash flow $500 or $600 a month. So if we were to take this and model, here's what it looks like. I take that red light condo with about $200,000 of equity, sell them, and then do a 1031 into these 2 properties. So you can see here that I need about $196,000 in equity. So about models how much equity I have to play with, give or take a few bucks in transaction cost, of course. But here's what matters. Return equity going from 7 to 23%, and cash flow going from about $1,600 to about $11,500 a year. Guys, this is the numbers we used to see in trade-ups in Denver and Springs in the last market cycle. Hey, you can go out there and 3x your ROE and 4 to 5x your cash flow. So if you want to be hands-on, great opportunities out there. The other thing too is these properties are very, very 1031 timeline friendly. These aren't properties that are, hey, we're going to build this in 2 or 3 years. It's, hey, these properties are already under construction and they have, a closing date 2 to 3 months out from completion, which works really well for that 6-month 1031 timeline window. Now, if I were to do this, the play I see is, hey, 1031 out of Denver, get that new build opportunity, buy that next up and coming market. And then in 4 to 7 years, reposition. This is your strategic chess move. Reposition equity, sell, and move the equity elsewhere. Your ROE will be starting to decline. You'll start having no longer a new build, but some deferred maintenance starting to build up. Great time to sell to an owner occupant and then move the money elsewhere. Now, I want to share a story on here because I don't invest out of state in direct rentals. I do that through like partnerships and syndications. But I know a lot of people that have successfully and not successfully invested out of state. So that is, sorry, someone commented on here. I just realized, not Charlottesville area. I meant to say Charlotte, North Carolina. Thank you for pointing that out, Kim. Yes, I was thinking college football, Charlottesville, Virginia. I'm talking Charlotte, North Carolina is the market I'm talking about. Thank you for pointing that out. So coming on here, back to this idea of investing out of state. Number one, get the market name right? Ha ha. But really good example. I was actually at an investor mastermind last week, and one of the investors I sat with, very successful career here in Denver, husband, wife, flipping team, lots of great success on there. And then they went out there, and I think it was in Indiana, or maybe Illinois, a Midwest market. They went out there and I think it bought like 4, 5, 6, 7 rentals out there from new builds in this very similar thing. Hey, that next upcoming market, they got some great deals. But here's the thing. They know the market. They fly in and have a vacation home and family an hour or 2 away. They grew up near the area. They know it well. They go back and revisit it. They've been out there knowing the submarket, meeting contractors. Like, they've invested the time, but now that's a large part of their nest egg and rental portfolio. And we review the numbers like, oh, these are all green light ROEs. Yeah, keep them, right? These make sense. So for the right person willing to invest the time and willing to travel out there, some amazing opportunities out there in out-of-state investing. Yes, Fort Wayne, Indiana. Thank you. And a good point here on 1031 exchanges as well. Always make sure you're working with a good QI, a qualified intermediary company. Lots of great ones out there. If you need one, let me and the team know. We've used a bunch over the years and have some fabulous recommendations. But that's opportunity number 5, looking at new builds. And then, again, if you want more details on this one or other ones, make sure you fill out that form, check the ones you want. We will send you information, and we'll also make the appropriate introductions. Like I said, some of these deals are deals that we are doing and are actively involved in. And a lot of these deals are like, hey, this is a great operator, great partner. Here's what we know. Meet so-and-so, and you're off to the races. So fill out that form, you get details and the appropriate introductions. So moving on here, opportunity number 6. This is 1031 exchanging into multifamily. So for active operators, there were great opportunities out there. For passive investors, there are great opportunities out there. But I'm going to spend a minute and really talk about the active one on here, since we do have active and many people did BRRRRs, or they go out there and read a Bigger Pockets book from 15 years ago and go out there and BRRRR. And BRRRRs would go out there and buy a house for cheap, buy it, rehab it, rent it, refinance, and then repeat the process. Works amazing, great playbook. The problem, the play doesn't work here in this marketplace. So if you're in that BRRRR mindset of wanting to add value, increase cash flow, increase equity, I would really shift away from single family BRRRRs and look for multifamily. Now, multifamily, call them value add. Value add and BRRRRs are essentially the same thing. So a lot more opportunity there, and also much more scalable as well. I'd rather have 3 4-plexes than 12 single family homes. All right. So let's spend a minute here and talk about multifamily trends. This dashed line at the bottom is commercial multifamily. And you can see here when rates went down in 2020, value shot up. And then when rates started going up, values dropped, right? That is how commercial multifamilies go, because they are a lot more rate sensitive. and they trade on their performance, unlike homes that trade on comps. So this is 5+ commercial multifamily or apartment buildings. This green line here is 2 to 4 unit multifamily, duplexes, triplexes, fourplexes, and this is residential multifamily. So you can see commercial apartments prices have dropped. They have, I would say, have crashed, right? Hey, we've bought places at 2019, 2020 prices, sometimes even a little less. Residential multifamily, not a crash, but it's pulled back some. Hey, it's softened. There's some deals out there, 5% off, but not 20% off type thing. So there are opportunities in both, and they're both very different games. So we'll talk about this. In the 2 to 4 unit residential, I think there's some great plays where I call light value add opportunities for that hands-on investor. So like I said, there's been a small price reduction, more than SFR, but a lot less than apartment buildings. So many multi-units have long-term owners, like 10+, 20+ years of ownership. The rents are below market. The units are outdated and need updating. There's huge opportunity for operational efficiency, implementing utility bill back, LED lighting, and better water flow, just better ways to go out there and make the property a better performer. Now, a lot of times these landlords, they might be in their 60s or 70s and they're just ready to exit. They're on the other end of their journey. Like, hey, I want to cash out and move on with things. And so we've seen some really good opportunities out here, because for a lot of these people, hey, they bought this fourplex for $100,000. Now it's worth $900,000. A lot of them, they don't care for a few bucks. They're like, I just want to cash out and spend time with my grandkids. So we've seen some good opportunities, and that's the type of property a lot of times you'll look at. Occasionally we'll get a distressed property, but a lot of times that's a general seller avatar. An additional opportunity on here is getting these properties and getting some Section 8 residents in there as well. In the Denver and Aurora housing authorities, and every area has its own housing authority that implements Section 8, and these are the government guaranteed, government subsidized rents. In Denver and Aurora, they often exceed fair market value rents by 5 or 10%, which can be a big boost to your cash flow. And a lot of times, Section 8 tenants often stay 2 to 3 times longer than market tenants. So good opportunity here for investors who want to be a landlord, and also investors who want to be a house hacker, and they can now utilize that 5% down conventional loan. So here is taking an example of that same condo I've been using the whole time so far. It's a red light condo, $200,000 in equity, and I come out here and do a 1031 exchange. So you can see here, and I'm exchanging into a stabilized property. And I'm assuming it's going to be a 7% cap rate after value add and stabilization. I go out there and buy a property like this, put some equity in there and get it performing well. I take it down with a 6 3/4 interest rate loan from a DSCR loan, since those tend to be cheaper a lot of times, especially for multifamilies, for an investor loan. I am self-managing, so no PM fees, and I'm putting a little extra hustle and sweat equity to save dollars and juice returns, right? Well, if I do that in a year or two, I could be having a property that's in that 18% equity with decent cash flow. So 3x, 2 to 3x return equity, 4 or 5x cash flow. So that puts it back into green light. Lots of really good potential there for that hands-on. And a lot of people at their phase in life, hey, you got 15, 20 hours a week to invest. You got some experience, you got some capital, you still got some hustle and wisdom, great opportunities out there. Now, if you're a hands-off investor, which is, the real Chris Lopez, if you go out there and get a property like this, put a PM in there, don't put the extra sweat equity in there and hustle, you'll be in like a yellow light type ROE. Not horrible, but not really great as well. So 2 opportunities there in the small multifamily, and some good ones, like I said, for those hands-on active investors. So now I want to shift over from residential multifamily to commercial multifamily on here. And commercial, again, is 5+ units. Understand, when you get to 5+, I mean, laws, lending, everything changes. It's a different ocean you're in. So the best opportunities right now are in commercial multifamily, or I like to call them apartment buildings. And also, generally speaking, commercial deals just offer superior deal structuring strategies compared to residential. There's a lot of residential laws in there to protect the consumer, where commercial, they don't have those consumer protection laws for it. So one thing that surprised me and many investors out there I know and operators is we all saw the prices crash, right? In 2023, 2024. Deal flow and transaction volume have been much lower. And this has been my experience, investors. I go to conferences, I read market reports. Everyone is out there and kind of surprised that there's a lot less volume. I think a lot has to do with the extend and pretend that banks have been doing with properties, and we'll restructure this loan for a year or two. Like banks are getting creative so they don't have to foreclose on the property. So we've seen a lot less deal flow, which means it's harder to find the deals. There's been fewer than we thought, but there are some amazing ones out there. But understand, for commercial deals, commercial brokers control the deal flow. They control the destiny, generally speaking, especially markets like Denver and Springs. And they're going to give their long-term investors their first look and first opportunity. Like most commercial properties are sold, they call a pocket listing. They're not publicly marketed. The broker will get it, call one or two investors, and a lot of times sell it for the amazing deals. So here's the thing. Low deal volume, but it is picking up right now in 2025, and brokers controlling it, it does limit the opportunities. So if you want to do this, make sure you go out there and you network hard. You have to go out there, network, and really hustle to go out there and create that deal flow for yourself. I see some questions I'll come back to in a few minutes on. So here's how I see the landscape for apartment buildings. If you're an active operator and you're in Colorado or want to invest here in Colorado and live here in Colorado, look for 5 to 15 units. 5 to 15, 5 units. This is often the transition between like resi and commercial. Now, 5 is the official, transition number, but in reality, that's kind of the transition. So a lot of times it's too small for like commercial brokers to play in. And so a lot of times a lot more resi agents will play in that area as well. And there's opportunities on here because there's some really good brokers that focus in that 2 to 15 or 4 to 15 range. But a lot of resi agents will get the properties because, their client or their friend from church or the school, elementary school. Oh, hey, help me sell this property. Oh, I can help you sell that property. And we have bought some amazing deals over the years where a residential agent has listed a 15 unit. And it's like, okay, you totally mispriced this, but that's your problem. Our gain, right? So look for those opportunities on there. Once you get about like 15 or 20 units, a lot more competitive. But I think there's good opportunity for hands-on in that 5 to 15 unit range. Now, out of state, again, going back to, hey, where's the next Denver? Where's the next up-and-coming market? If you're willing to travel and commit and spend 1 or 2 years stabilizing properties and really getting to the market out there, there's some amazing opportunities out there. I know a handful of investors, they've built, quite a nice Denver portfolio, and they're going to Alabama or Arkansas or North Carolina and actually doing this, but then they're traveling out there. They have family, they have market knowledge, and they're 1031ing their money from here to those markets. So great opportunity there for investors like that. Now, if you are a passive investor, understand these operators, they need capital. So an example here, and this is just me being, truthful about my situation, which I want you to be truthful about your situation. I have a lot of knowledge in, the rental and multifamily acquisition and operations business. I've gotten the privilege of working and investing and interviewing a lot of top multifamily people out there. And two things happen. The more I learn, the more excited I get. And the second thing is the more humbled I get because I'm like, oh, wow, I know this, but you are like, I'm at level 1, you're at level 31. And, they might have 10, 20, 50 employees. I'm like, wow, okay. Could I build that business? That's hard to build a business at that scale, just generally speaking. But I'm also like, hey, why would I try to replicate that versus just take my money, invest in the deals with you? So as I've gone through this, I've learned a lot, but also realized that a lot of people out there are much better. And if you want to go out there and play in the bigger commercial space, you need a true operation of anywhere from 5 to 50 people, depending on what type of operation you're looking at. So here's a case study of a deal I invested in December. So your typical multifamily value add, 172 units in Omaha, Nebraska. Now here's the punchlines or highlights of it. It has an assumable Fannie Mae financing at 3.2% interest rate. Again, assumable loans is a lot more common commercial than resi. 3.2 rate for 7 years. I was a mom and pop owner that had not made any significant interior renovations since their acquisition. Budgeting about $10,000 per unit to increase rents by 25% or approximately $190. Also improve expense ratio with in-house property management, low vacancy in the market, many units not available for 60 days. And they look at the sales comps. Hey, we got a good deal on here. A lot of properties traded at $100,000 a door. We closed at $65,000 a door. So here's a simplistic example of me selling my condo, taking the equity and putting it into this 172 unit. Now I'm going to highlight here. I put a new section up here, year 5 in the screenshot. So property allowance defaults to current year, like year 1. I want to look at year 5. Why? Well, that's when we're usually sell a multifamily property, but also it takes 2 years to implement all these changes. Year 1 numbers don't look good. Year 3 numbers start looking pretty good. So I wanted to fast forward to year 5, kind of like the end of the business plan. So the left here shows if I keep the condo for 5 years, then my ROE drops some, my cash flow increases a little bit. I'll have paid off the property in 5 years. But compare that to this. Look, ROE goes from 6.5 to almost 20%. Cash flow would go from $5,000 to $27,000. So, and this is what I'm showing here is I got $200,000 in equity to invest, right? It takes more than $200,000 to buy this property. I'm just kind of showing you my pro rata ownership if I were to take that equity and move it on to there. Now, here is a snapshot from the investment memo on here. Overall, this is a $13.7 million deal. It's an 8-figure deal. And these are the type of deals that are just amazing right now in commercial. We're getting these 8-figure deals, which is near impossible for a solopreneur to invest in, right? A solo investor, really hard to go out there and take down a $13 million deal. But you can see here, this is some of the creative deal structure and also kind of shows an example of what's available in the market out there. Get these amazing terms. And once it's stabilized with that assumable loan, we'd be at a 2.5 DSCR coverage ratio. So really great opportunities out there. Now, this leads us into number 7, which is going from active to passive investing, really converting your portfolio, converting your equity. Look, the 117 apartment building is a great example of a stellar deal and also highlights the obstacles for a solo investor. The deal is simply too big. And so these are usually done with real estate private equity, which is a fancy way of saying, hey, a company or a group will go out there, take down this building. They're going to go out there and raise $5.9 million from investors and then buy this property. They operate it, and then you're just an investor. So simply put, a lot of us are landlords. We find a property, underwrite it, personally guarantee it. With the mortgage, we manage it. We take all the risk. We take all the reward. With real estate private equity, you can invest money, and then that group or the main investor called the general partner, they're the ones doing lots of work and some money to go out there and handle the big project. So here's a very simple thing for what LP, which was me in this last deal. Hey, I write a check, and it's kind of like buying a stock. I invest money, I get my reports, I get my distributions, but Tim Cook at Apple, Elon Musk at Tesla, they don't care what I say, right? I just give them my money, and then I like the business. The GP, they're the ones taking the risk and doing all the operational stuff. So won't go into details on there, but I want to highlight 3 areas I'm investing a lot of my own money in, and I think make a lot of sense. And so I invest a lot of money in multifamily deals and debt funds right now. And so 3 areas I invest in multifamily is I've done a lot of value add over the years. And so I'm actively investing in deals here in Colorado, Denver and Springs, and some select Midwest markets like Iowa and Nebraska. And currently, over 1,000 units that I own. I own a very small fraction of 1,000 units. But I've been investing in value add deals, some amazing deals like that Nebraska deal I talked about. I'm investing in 3 apartment developments here in Colorado, 1 in Wash Park, 2 down Colorado Springs, and these are all ground up development. And then some build-to-rent communities, which are a newer form of multifamily. Think about them as horizontal apartment buildings. They go out there and will build a 150, 200, 300 subdivision of detached homes. But rather than selling them off to individual users, they all build it to rent and then they have one ownership group and one property management group. And this is one of the hottest trends in the market right now, because a lot of people can't afford a home, and or they want to get out of apartment buildings, and they can rent a home for a lot cheaper than going out there and buying a home. And then, of course, these builder-rent communities have all the amenities of an apartment complex. So a big question, common question. This was my first question. I was like, oh my gosh, this stuff is amazing. Can I do a 1031 exchange? No, you can't. Private equity deals are securities, because essentially what happens is you are investing in an LLC. You own shares or are a member or a partner in the LLC, hence the limited partner. And then the LLC owns the real estate. So this comes up on here and people say, I don't want to do it. Well, just like low interest rates, some people say, I never sell because of low interest rate, which I think is not the right decision. Don't make the only investment decision criteria based on your potential tax consequences. Is it important? Yes, it is. But one important decision in your decision matrix of keeping or selling the property. Here's the key point. If the new investment has a high enough rate of return, it will go out there and overcome the tax burden in the long run. So understand, you have to understand, hey, is this new deal, is it so much better and I'll get a better rate of return? It handles any taxes I may have to pay on selling a property and not doing a 1031 exchange. So here's a spreadsheet with a lot going on here. And what this does, this shows if I were to keep the condos, keep the condo and at 7% return equity. I use stocks in my risk-free rate of return, right? And then I do a value add, the Colorado apartment development, and this build to rent. So I'll spend a minute walk you through on here. So you can see I have about $192,000 in equity proceeds. That's after transaction cost. If I keep the property, I'm assuming I'll get that 7% return equity. Again, it'll be a little higher, but understand, hey, it's going to be not a great return next couple of years, right? We know that. Stocks. If I sell this, I will pay about $35,000 in taxes. That's about a 22% tax rate on gains and depreciation recapture. I have $157,000 to invest, and I said I put 10% in. So yellow fields are the fields I input how much I think I'll compound a year. Well, 10%, look at this. By year 5, the property should be about 270 between cash flow and equity. The stocks are like 250. They're getting close, even though I pay taxes. But that rate of return, a 3% difference, is not great enough to overcome that tax burden. Next one, and again, these are all real deals I invested in. I invested in those value add apartments and funds. Invest $192,000. I got some depreciation that year to help offset taxes, so I had $173,000 to invest. I'm targeting a 17% annual return on there. Go to year 5. Wow, I should be at 380 in combined cash from equity compared to 270 on keeping the property. Okay, we're getting some velocity here. Even though I paid close to $20,000 in taxes, assuming I get the projected return, I could be sitting a lot prettier. Now, the development funds or development projects, those don't have depreciation the first year. Some have depreciation years 2 or 3, but in year 0, they don't, because it's a piece of dirt you're owning. It takes a year or 2 to build. So this apartment fund, I would pay full taxes on here. But if I make a 25% return, which is within the projected range, by year 5, I'd be at $480,000. Build to rent. And again, this is Colorado on the left here. This is Ohio, is a deal I'm investing in. Great market dynamics and also a lot more landlord friendly. Projected to be about 22% return. Well, I'd be at $470,000. So look at these year 5 and year 10. Because when I look at repositioning equity, I can have like year 5 as kind of like, major milestones where I reposition them. So you can see if I'm able to keep that compounding, if we look at year 10, the keep it, if I did nothing in the condo, about $380,000. My stocks should be worth about $30,000 more than my property. When you get to multifamily over here, if I can keep that rate of return high, we're in the $800,000 to $1.4 million range. So really something to think about, just a conceptual shift is, hey, if I can get a better return on my money, I can potentially overcome that tax burden. Now, if you're wondering what these blue highlighted cells are, year 5 for value add and year 4 for his other 2. These are when the deals are projected to sell, and I'll get the bulk of my money back. I have to go out there and reinvest again. So that's why those areas are highlighted in the blue. We can talk a lot more about that in future ones. So want to keep talking about opportunity 7 here, active to passive investing conversion key points. Passive investing is a very powerful way to invest in commercial real estate without the personal time or expertise required. I simply can't go out there and access a 117 unit apartment building or go out there and plan on taking any type of like big development on my own. However, you must always conduct thorough due diligence. There was lots of pain from people invested, 2018, 2022 timeframe, from deals going sideways and operators getting a little, optimistic on their long-term projections. So good opportunity here in the market cycle since the pain has already happened. Don't worry about past deals. I'm worried about deals I invested in 5 years ago, not deals I'm investing in this year. But leverage your landlord experience to vet the deals and the operators. Like you know how to have deals and people kind of pass the sniff test, right? Hey, 0% for maintenance, that's BS. Oh, you're going to get a 10% annual rent growth rate? What the hell are you talking about, man? So you have a really good experience on there of not just equity, but leverage your landlord experience. Now, of course, always go out there, talk to your CPA, to figure out your tax liability. And then the majority of these deals require to be an accredited investor, meaning $200,000 a year in income if you're single, $300,000 if you're married, or over $1 million investable net worth, basically everything you have minus your primary residence. All right. I see some questions here on multifamily. I'm going to come back and answer those at the end just for the sake of time on here, but some great questions in here for Section 8 and some rents. Moving on to Opportunity 8 on here. This is what I call be the bank equals cash flow. So I went through another big paradigm shift, I want to say about 4 years ago, I think, about how to invest and where I sit in the capital stack. So the capital stack just means, hey, all the money, where's all the money coming to fund this deal? And a deal has to come up to 100%, right? And usually it's equity, your down payment, and then bank debt. Now, there are 4 main ones: common equity, preferred equity, mezzanine debt, and senior debt. We're not going to talk about preferred equity and mezzanine debt. I mean, most of us are playing in the common equity and the senior debt world. So the common equity, which is the down payment on a house, or if you invest in one of these syndications or invest in a partnership, usually common equity. And that has the highest return potential, but also usually the highest risk potential. Who is least likely to lose money in a foreclosure? The bank or the investor? Well, the investor usually gets wiped out. The bank may lose none or some money. So typically the bank sits in a safer area to go out there. So my mindset shift was I'd always been an equity investor. I had 50 people tell me about be the bank, lend money, do all this. And eventually that 49th person said it one way or just clicked with me. And I was like, oh, I get the benefits of being the bank. I understand it now. And so I started researching more and started investing in opportunities to kind of like, quote unquote, be the bank in deals. So a common one, and what I invest a lot of money in, is private lending debt funds. Now, from a very simplistic manner, this is, for fix and flippers, investors, people that need capital out there. So there's 2 ways you can do it. One, I can go out there and go to my local event or go onto a website and find someone and say, hey, I got $100,000. Kim, the flipper, needs $100,000. I write a note and I invest with Kim, or I loan the money to Kim. So I have all my money in one deal. So I have to find a deal, vet the deal, manage it, all that stuff. Which I like the idea, but again, I don't want to be hands-on, and I am not an expert at underwriting operators and properties from the bank perspective. And I don't have the expertise nor the time. So I invest in debt funds. So this is what a lot of hard money companies have. If you ever gotten the fix and flip loan, the hard money lender, their capital probably came from a private group of investors. So if I have $100,000, I can invest in the fund, and then that money will be utilized with other people's, and it might be spread across 40, 50, 60, 70 loans. So I get diversification, and also I'm not having to go out there and source and vet the deals myself. So I invest the capital as an LP or limited partner. The debt fund operators, that's their full-time job, their day job, they underwrite, issue loans. The end borrower will use it for fix and flip. They pay interest and fees. The hard money debt fund operators collect it. And then as the investor, usually receive monthly or quarterly interest payments, and then some profit share as well from the overall fund profits. So to show on here, debt funds are great at cash flow, but that's all they provide. Now, debt funds will range anywhere from like 8% to 30%. I went back and looked at, hey, where were all the deals I saw in 2024? And they range between 8 to 30%. Obviously, different risk profiles there and different business plans. But if you look at the 4 ways to make money, appreciation, 0. Debt pay down, 0. Depreciation tax benefits, 0. This is all cash flow. That's the only one area you're making money in the 4 ways of real estate. So continuing on to here, being the bank, investing in private debt funds is the best double-digit cash on cash returns that I have found, where I can go out there and achieve them. And it's good risk reward and not actively hands-on like I am with a self-managing room by room co-living rental. Now go out there and find a good multifamily deal. Hey, value add is going to pay 5, 6, 7%. Development deal, hey, they'll pay out 8, 9, 10% cash on cash as it gets stabilized. Again, very hard to achieve 10% plus cash flow in the market. Debt funds I like the most. Typically, they pay monthly or quarterly, depending on the fund structure. And then your money is locked up usually anywhere from like 90 days to 2 years. So different levels of liquidity on there. And I've built different ladders of debt fund investments. So if you guys not invest in debt funds without being the bank, really cool thing to look into and a really good mental shift, really good thing to look at as well. So I want to pause here in the 10 opportunities and do a case study because this is 2 red light condos that I sold recently in actually March of 2024. And I want to show you how I invest them and kind of like the math. I threw a lot of information concepts at you. Now let me show you a real deal and what I've done with my personal capital. So like I said, these were condos I bought, I think in 2020 in Aurora, and I sold them both in March of 2024. I did not do a 1031 exchange. Why? Well, because I want to invest in these passive deals where I could not do a 1031. So I paid some taxes and converted the rest to passive investments. So here's my macro strategy for me and a great opportunity I see out there for investors. This left chart here is just a generic nationwide equity of single family houses. So you can see here, this yellow line is equity. This red line is debt. So we were sitting on massive amounts of equity, right? In 2015, we had about 5 trillion in equity. Now it's like, 15 trillion equity. So just massive growth. So the old idea of sell high and buy low. Now I wish I could do a 1031, but I can't. And I think the upside in these passive deals will overcome any upside by holding. So that's my macro strategy on here. So the proceeds, everything said and done. These are 2 condos, very similar things, both, I think like 9% ROE. But here's what it was. After everything, I had about $200,000 in equity after loan payoff, closing costs, and fees. I also freed up $20,000 in bank reserves because not owning rentals freed up my 6 months of cash reserves I kept. So about $10,000 per condo. At a 22% tax bracket, I estimate about $40,000 in taxes. So 230 plus 20 is 250. 250 minus 40 gives me 210. Now I'm investing some of that into a multifamily value add fund, which will give me some depreciation benefits in year 1 in that $10,000 to $15,000 range. So here's how I invested the money. And I estimated I had $220,000 to invest. And I put $30,000 aside to pay taxes. And in April this year, I'm going to pay my $30,000 estimated tax payment, which is hopefully a little bit over. But I put that money aside. I invested $220,000. So here's what I did. I put $101,000 into multifamily value add fund, like the deals I showed you earlier. I put $70,000 into private credit fund, and they're paying out in the mid-20s. So there's some of the higher ones. So great structure and a Midwest market with higher yield. And then $50,000 into an apartment development fund. So $220,000. That's how I invested. Debt fund. So I could have invested all in the multifamily value add fund for depreciation, but I wanted diversification and get into different investments. So here's what I estimate in 5 years. The left side here is showing my cash flow, with majority coming from the debt fund and then some cash flow from the multifamily projects. The right side, if I kept my condos and then I had some I could increase the rents because my tenants were low in their market rent on there. So you can see here I modeled for 24, 25, 26, 27, 28. And then 28 here is assuming partial cash flow for that year, and then all the sales proceeds after loan payoff and fees. So you can see the passive portfolio, I'm about doubling my cash flow estimate, and I'll be over 484 versus 295 for my total proceeds. Cumulative cash flow and proceeds, and these are estimated, about 550 for passive and about 335 if I kept my condos. So this passive portfolio should give me about a 65% increase in total cash and equity. And then the IRR, I'm estimating to be right under a 30%. If I kept my condo, it would be about 12%. And what this does, this takes into account time value. Money helps you figure out, hey, what's your average return per year? I should be around 2 to 2.5xing or increasing my IRR. So this shows you if you get into better investments with that higher rate of return, you can overcome that tax hurdle. So to wrap up this case study, so some key points, and this is why I sold. Going back to my strategy and the opportunities, condos have strong headwinds. And December 2024, the median sales price for detached homes rose by 4.9% year over year, while attached homes fell 4.4%. And then we're seeing year-over-year rent growth in condos and Class B and Class C multis over year. They've been in the negative 2 to 10% range. So that, the condo market out of the residential market, they've gotten hit the hardest, at least here in Denver, generally speaking. And that growth wave is over. And that's where we're seeing like the biggest pullback in terms of like prices and performance. Now, if passive, I should get more cash flow, more equity growth, less headache and less liability, less time and less bandwidth. Now, I did these deals in March, so almost a year ago, and I already have had the capital deployed. I've already had some distributions. I've got insight in the deals I've made. Would I do the deal again? Yes, I would. I like what I did. I like how everything is performing. All right, now moving on to the last two things here, and we got 10 minutes left. These are 1031 alternatives. Many investors, myself included, have properties with such a low basis from multiple 1031s or doing cost segregation study that it's really hard to go out there and bite that tax bill. So they kind of want to have their cake and eat it too, but don't want to do a 1031 exchange. So 1031s are great because you defer your taxes. And then once you die, your kids get the stepped up basis. Here's the reality. With anything in tax advantage stuff, you eventually pay the taxes or you die. They're both not ideal, but that's the outcome for how a lot of these deals work. So I want to give you an example here because a property I have is a fourplex with a red light ROE, and then it has a multiple six-figure in tax bill. So like the other properties, I did not have a really low cost basis where I could sell, hey, bite the bullet, invest, owing $150,000 tax bill. I've not had the privilege of writing a six-figure tax bill. I don't want to anytime soon. So this brings me on to opportunity number 9, qualified opportunity zones or qualified opportunity funds. There's a lot of QOZF acronyms you'll see, QOZ for short. These are similar to a 1031. QOZs allow you to defer capital gains, but you only need to invest the capital gains portion, not the full proceeds. And unlike a 1031, you can sell any asset, stocks, crypto, real estate, business, and invest them in a QOZ property within 180 days. There's no like kind requirement to do here. Here's a big win. If you hold for 10 years, you'll pay 0 capital gains tax on the QOZ investment appreciation. You'll pay some taxes on the property you sold, but the gain on the new property, you will not pay tax on there if held for 10 years or longer. So QOZs can be more flexible than 1031s for diversifying out of high gain positions while potentially eliminating future tax liability on appreciation. However, lots of rules and lots of stuff to talk about here. So here is a snapshot of my property. It's actually one of the condos I sold, bought a fourplex worth. It's worth about 1.15 million now, but my basis is just below $500,000. So I'll owe about $130,000, $140,000 in taxes. And if I sell, I walk away about $500,000 in proceeds after loan and fees and all that stuff. It's a 9.5% ROE. So it's upper end of red light. So take this with a big grain of salt and just high level. If I were to invest in a QOZ, and this is what I did from a QOZ calculator, and you can click that link to go do it yourself, taking those numbers and investing in one of those Colorado Springs types deals I mentioned previously, I did that math because one of those deals allows for a QOZ. So I'm using a real deal in a 10-year apartment development. So I would save about $22,000 in taxes from selling the property today, and I owe those taxes in about 2 years. And then, assuming that $500,000 turns into a $1.5 million total position, I would have about $1 million in gain, fast forward 10 years. Well, on that gain, I'd pay zero taxes, and that'd save me $220,000. So I can potentially save $250,000 in taxes, defer a lot and not pay some, and eventually get some equity out so I can go out there and have liquidity and go out there and do what I want with the money. Now, in 10 years, hey, I'll be in my early 50s. I'll be starting to worry about weddings and college tuition and other investments. I like the idea of, hey, I can free up, $1.5 million in liquidity. That's huge. Go out there, reinvest, and also pay some life expenses as well with it. So a lot more details on QOZ is coming. We're actually filing a few details for some Colorado Springs QOZ deals. We'll be doing a webinar soon on there. It is top of my list as I'm doing it myself. We also have a bus tour scheduled on February 20th to visit some of these properties. If you're interested in QOZ, the bus tour, let us know or go out there and fill out that form to get all the information. All right. Opportunity number 10. Last but not least. These are 721 exchanges, or called a 721 exchange. And this is a old thing in the tax code, but a really new concept for many people. So it has a lot of the same benefits as the 1031. What happens here is you, on the left here, the smiley face, you sell your rentals to a fund. And this is a real estate investment fund. And then they give you equity or shares of the fund back. So a lot of similarities to 1031, a lot of similarities to REIT, but its own thing. But you give your property, you sell your properties, you get the shares back. So what this does, it gives you diversification and simplification. So this company here we do work with in Denver called Flock, and I think they're the biggest single-family 721 company I've seen. So here are two examples of a case study, and this is a real Denver case study that they closed on. Two single-family homes, one in Denver, one in Parker. The landlord did a 721 exchange into Flock's fund. So you can see here, 2-bed, 1-bath, 4-bed, 2-bath, and the estimate, hey, the value, repair cost, everything like that. So after everything's said and done, and I got the breakdown over here, about $750,000 in equity they get in the fund. So they sell those two properties in the fund. What do they get? They get a different type of return profile. So this is a snapshot from Flock's proposal system, which is really slick. And you can see here, the overall return will be between 8 to 12% annually, with cash flow, a max cash about 3.8%. So depending on what your needs are, they actually allow you to like say, hey, I want more cash flow today. Great, more cash flow, but less future upside, or hey, less cash flow and more upside. So you can toggle on here and see what it does and gives you a breakdown about what your cash flow is. A lot of times, though, you'll get cash flow and be in that 8 to 12% range. I like this play because, yes, it's similar to stock market returns, but you could have like you're kicking it too, but not paying taxes on here, but you're diversified and you're not taking on active ownership risk, which, hey, I'm happy with that for stock market-like returns. So, but when you exchange a property, what do you get? So this is a current snapshot of Flock. You can see they're in probably on a 15 or 20 markets, over 800 homes in the portfolio, $176 million total value, about 30% LTV. So you have your two properties in this case, exchange it. Now you own the equivalent equity of $750,000, but rather than two properties, it's across 800 properties and they are growing every single year. So some key points on here is You have flexibility in cash flow, and you can preserve upside. You get to go passive and have diversification. And the really cool thing on here, you get some really neat estate planning tax benefits. So a lot of times when you do a 721 exchange, you have to hold the shares for 5, 6, 7, 8 years. But when it comes time to sell, rather than selling and save 100 shares, you don't have to sell all 100 shares at once like you would have one property. You can say, I'll sell 10 shares this year, 10 shares next year, 10 years the next year to pull out cash when you need it, or to defer taxes or minimize taxes in the long run. It's also a lot easier from an estate planning benefit. If I have 2 properties and 3 kids, creates issues. But hey, kid 1, kid 2 each get 50 shares, right? Or whatever it works out to be, and they can do what they want with it. And they also won't run the properties into the ground. So a couple key points on here, at least for Denver, and always confirm with Flock, but I think their rentals they buy have to be less than a 40% LTV, and that helps them, keep that 30-ish% LTV in their portfolio. They're not taking condos, but may later this year. And their timeline from like due diligence, offer, and closing is usually 3 to 6 weeks. So this is a really good opportunity for people that just want to like be hands off and cash out. I think it's better than DST. So if you're interested in that, let us know. With that said here, this brings us to the end of our webinar and the 10 opportunities we have. So please go out there and make sure you fill out this opportunity form. You choose what information you want for what opportunities. And then we also have some other things on here. If you want a key renter compliance audit, or hey, come do the bus tour with us, how to do due diligence, do some more advanced underwriting. Let us know what you're interested in, and we will get you all the details and, like I said, make the introductions. The other thing, this is the other QR code on here. The other form we have is make sure you come join us for some masterminds. We are doing a whole bunch here in the rest of January and February. We've got some in-person ones next week, January 28th and 30th. Our Fire and Fire, which is with Paul and Jamin on the from South Metro Fire. They do a lot of stuff with firefighters and first responders. They're doing one at the Firefighter Union Hall on Monday, January 27th. Everyone's welcome, but much more geared towards first responders. We're doing a house hacking one February 5th. We've had a lot of house hackers on here and said that's such a unique investing strategy. Want to do your own mastermind on there. And then February 6th, if you can't make an in-person one, we are doing a virtual one February 6th. Now, I think we'll do more in February, but we're going to get through these ones. We keep them maxed out at 10 investors, ideally 5 to 10 is a sweet spot. So those will cap out. If you want them, go in here and just reserve a time and fill out the form and let us know. So I really appreciate everyone coming out and hanging out for a few. It is really fun to go through all this stuff, and also really neat to see all the questions in here. So we got a few questions and a few minutes left, so I will run through them. And I do have a hard stop in a few minutes. So a couple questions on here. Hey, how do you plan for repair cost? How do you do percent rent? That's going back to multifamily. That's a much deeper question. I have time to go into, but if you want that, fill out the form, and I want to close that and select apartment building underwriting. We're going to be doing some detailed stuff on underwriting for actually, hey, value add development. How do you assume all these costs? Great question. Can't give you a good answer here in this. Question here on, let's see. Section 8. Oh, a lot of people who like Section 8, yes. Sorry. I see more questions and comments in here. Unfortunately, I can't get to more of those. A lot of people are saying thank you or commenting, yeah, I agree with that on Section 8. A good opportunity here. I have to hop off. We're also at the end of our 90-minute webinar. We've had almost every single person stay with us the whole time, which is awesome. Thank you for coming out. If you have any questions, reach out to me, reach out to the team, fill out the form, come to these in-person masterminds. Our goal here is to help you make decisions, informed decisions, and say, hey, here's a buffet of options. Pursue the ones that make the most sense for you and your family and your financial goals. So everyone, thank you so much. Privilege of getting to present to you. Lots of fun as well. I can't wait to talk with you and meet with everyone here next couple of weeks. Bye, everyone.